Yeah, Shane, it was Trump's tariff mandate that really caught the Fed flat-footed. And the sudden race to repatriate paper gold positions into safe haven first-tier gold exposed the inelasticity of the available physical bullion at current prices, meaning there just isn't enough bullion at current prices, meaning that it has to be bought back at higher and higher prices. Now, we previously posted the link and took apart the LBMA video. You remember this video that the LBMA came out and they were saying, oh yes, the idea 8 to 10 week refiner delays for COMEX compliant 100-ounce bars. They're just related to COMEX exchange and, really trying to spin it as, no, there are no real shortages. That backfire, and it drawing really unwanted attention into the real extent of the global supply shortages at current prices. And despite allowable double accounting rules, making the true extent of the supply problems hiding, it's been the failure to physically load out the 400-ounce standard bars from the Bank of England LBMA vaults into a Basel III NSFR T+1 delivery protocol. It's that it hasn't moved that's really exposed the true scale of these delivery defaults. Now, we've previously drawn attention to the largely ignored it's called the GC4 Enhanced Delivery Contract. We spent some time looking at it, which enables a local London 400-ounce bar to remain in the London vaults without physically moving to the US vaults, so yet it's counted as there. Now, these flows also synthetically assist in closing the EFP spread, i.e. the spread between the paper price and the physical price. As an example, we witnessed this into an attempt to block central bank buy stops at spot 3,000 from getting tripped off last Friday the 14th. We knew that Asia would come in and take it, and sure enough, they did. Now, these failures to deliver have not gone unnoticed by competing central banks who have doubled down on targeting and locking in COMEX registered inventory for delivery, alongside locking in exchange for physicals at the AM and PM fixes for Basel III compliant market delivery. So in other words, central banks and sovereigns and the large buyers need a fix. So you might intraday it be higher and lower, but usually it requires an actual fix to mark that to market. So a SARS large size to market. So into all of this maelstrom of bullish inputs, the Fed trying to prioritize 400-ounce bullion repatriations ahead of an upcoming US Treasury gold audit is something that would never have happened had Trump not taken the helm. Now, these repatriation efforts have made it very risky to short sell paper gold into such large physical demand, and it's what has driven the unnaturally widened EFP spreads, the paper spread to paper to physical spread. And in other words, the paper price being so much higher than the physical price. And it was gapping to levels not experienced since the 2020 COVID refinery lock. And the EFP spreads simply represent the higher cost to close out an unbacked paper bet against global facing deliverable gold and silver. And I should add that while the Fed employs agent bullion banks to do their heavy lifting, every single bullion, without exception, is actually long bullion for their own books, i.e. they act as an agent. But this is where it gets really interesting. US market Basel III compliance on July the 1st will have as dramatic an effect on the gold price as when the FX gold market was brought into compliance on the 1st of January 2023. So in order to comply, the audit will have to be concluded well before the July compliance date. Now, the realization that hundreds of tons of underpriced paper market positions will have to be marked to a market price where a real seller of a fully owned bar is actually willing to put it on offer. What it does is telegraph much higher true supply demand prices, because they're not going to be paper diluted. And to give an idea of the scale of the next move higher, in line with what we projected when the FX markets became Basel III compliant in January 2023, the minimum next staging point for spot gold to rally was projected at 3,000. Now in sync with what our liquidity providers say we project it will ultimately cost an extra 3,000 to buy the same ounces of gold, forecasting a minimum of 3,300 gold price by the end of the second quarter. That's very conservative. And a realistic 3,500 by the end of the fourth quarter. Then we're looking at very large moves higher.
Let's not sugarcoat this. What we're witnessing is the complete unraveling of the gold and silver suppression system that's been operating in the shadows of COMEX and the LBMA for decades. And this unraveling isn't theoretical anymore. It's playing out in real time, and it's being driven by a combination of geopolitical tension, Basel III regulatory deadlines, and the sudden onshoring of physical gold into U.S. vaults at a pace we've never seen before. Since Trump's renewed tariff mandate, the Fed has been caught flat-footed. Suddenly, we're seeing a rush, not just by investors, but by sovereigns and the bullion banks themselves, to close out paper positions and repatriate metal. The so-called shortage is no longer a debate. It's staring us in the face. There simply isn't enough physical gold available at these paper prices. That's the story the mainstream won't tell you, but it's what the central banks and insiders know. And it's why we're seeing record-wide spreads between futures and spot lease rate spikes and delivery delays that are now being spun as logistics problems. Let's talk about that LBMA video from last month. They came out and tried to calm the markets, claiming that the 8 to 10 week delays for COMEX-compliant bars were just routine refinery bottlenecks. Nothing to see here, move along. But that backfired spectacularly. Instead of reassuring the market, it exposed just how deep the delivery problems run. You can't hide the fact that only 36 million ounces of gold remain unencumbered in the London vaults, standing against over 380 million ounces in outstanding spot contracts. That's more than 10-to-1 leverage. You can't keep playing musical chairs when everyone's grabbing for a seat at once, and what's making this even more explosive is the failure to convert 400-ounce London bars into Basel III compliant metal. The GC4 Enhanced Delivery Contract was created to synthetically plug the gap, allowing these bars to be counted without physically moving them into U.S. vaults. But even that sleight of hand is being overwhelmed by sovereign demand that wants real delivery, not paper IOUs. Let's not forget, the EFP spread, the exchange for physical price gap, is a direct signal that the synthetic market is no longer in control. Every time the Fed or a bullion bank tries to slam the paper price, physical buyers step in and take delivery. That's why the spreads between London and New York exploded last month. That's why the premiums are widening. That's why the Fed is now prioritizing the repatriation of 400-ounce London bars back to U.S. soil, because they know an audit is coming. It's widely rumored that Trump's Treasury team is preparing a comprehensive gold audit ahead of the July 1st Basel III deadline. And that means every ounce needs to be accounted for at a market-clearing price, not a COMEX fantasy price. This is unprecedented, and it never would have happened without Trump's push to collar Treasury bonds with physical gold. If you think $3,000 is the top, you're not understanding what's happening. That's the floor. Because once these hundreds of tons of underpriced paper contracts are marked to market, you're going to see gold repriced to where real sellers are actually willing to offer fully owned bars. And spoiler alert, they're not selling at $3,000. And don't think this is just about gold. Silver is moving in tandem. Over 128 million ounces of silver have been drained from LBMA vaults in just the past 3 months. That's almost 50% of the remaining float. And guess where it's going? Straight into COMEX, into U.S. vaults as part of this reshoring wave. And the moment COMEX delisted LBMA-linked futures, it was the final nail in the coffin. That was a vote of no confidence. When you can no longer hedge short positions in London, the whole suppression scheme begins to break down. This is why EFP spreads are now gapping wider than they were during the COVID refinery lockdowns in 2020. The difference this time? There's no way to paper it over. Basel III forces everyone to show their cards. And when the Fed is forced to market its entire gold position, currently held on the books at $42.22 per ounce, you better believe that repricing will trigger a generational revaluation event. So what happens next? If liquidity providers and central banks continue to front-run the market, locking in COMEX inventory ahead of July, we're going to see further short squeezes in gold and silver. That's not speculation. It's baked into the structure. Basel III doesn't allow for unallocated derivative exposure. That means the bullion banks, which have for decades taken naked short positions in coordination with Western central banks, are now scrambling to buy back those positions with real metal. The cartel is losing control, and they know it. Why else would every single COMEX-approved bank be long bullion for their own books, even as they act as agents to suppress the price? That's not hedging, that's front-running. They know what's coming. They're preparing for it. And if you're not doing the same, you're going to be left behind. This is why I'm sounding the alarm. This isn't about a short-term rally or a technical breakout on a chart. This is systemic. This is structural, and it's global. Physical gold and silver are being repriced by supply and demand, not by digital contracts written by institutions with no skin in the game. The July Basel III deadline is the next inflection point, and what happens between now and then could make 2020 look like a dress rehearsal. You can't afford to wait. The insiders aren't, the sovereigns aren't, and the bullion banks certainly aren't. They're accumulating. They're taking delivery. They're reshoring metal. Ask yourself, why? What do they know that you don't? Because I can tell you, $3,300 gold is not a moonshot forecast anymore. It's the next stop on a train that's already left the station.
And as we looked at last time, with gold outperforming every other asset class, bar none, a rising gold price has not gone unnoticed by fund managers who have never looked at gold investment, and this massive move into gold has only just begun. This is the point. February alone evidenced an all-time record high of 4.9 billion flow into gold funds alone. And that so far, and that's, we're talking about US funds. And so far, it looks like March is going to exceed that significant. Now, this gold has to come from somewhere. And with demand competing with Asian investment demand, and that it is bolstered by rising prices, so higher prices gets people more interested in buying more gold, just as it did when gold took off from 2000 when the Shanghai Futures Exchange launched back in March 2024, driving an $800 rally, which really railed against every top core time. Now, with an increasing percentage of futures market bets moving into the hands of funds seeking long-term exposure to gold as an alternative first-year asset, it's forcing bears to fold bets against gold and driving the 50-year unbacked paper to real physical gold gap to close. And as we know, many funds are not able to hold physical gold, so they buy shares in COMEX-related ETFs and exchange-traded funds. And these bets are seeking exposure to gold. They're sticky in nature and unable to be rinsed, as you say, into even when they rig synthetically constructed wash and rinse cycles. In fact, quite the opposite. People have figured the game out. The change in behavior is what we're evidencing here and now. And the physical-facing market-making insiders are aware and taking advantage of this bullish structural change in the composition of historically unbacked futures markets, becoming backed. And the fresh in-house demand is also competing with the Fed, trying to race to buy back underwater leases at market ahead of the July 1st Basel III compliant deadline. And why would it expect more attempts to cap 3,000 gold into large derivative bets being marked to market into options expiry next Wednesday? And first notice comes directly after that. And then the April contract then expires. Now, or these people are going to have to fully fund these positions for delivery on Friday the 28th. Ultimately, there's far too much offsetting a fresh safe haven buying evident at current prices for the cartel to sustain any lasting downside traction. Yeah, if you recall when we recorded our March 5th episode 2 weeks ago, silver was being capped at, it was $2 lower at $32. Where it was pretty obvious that capping at $32 into a strong demand undersupplied global market was going to become way too difficult, as insiders were being forced to short cover so as to accommodate New York dealers actually taking physical delivery to cover their COMEX short exposure. So alongside large backdoor loanouts, this was really forcing the price higher.
Now let's dig into where things get really serious. And I mean systemic level serious. We are not talking about fluctuations on a chart anymore. This isn't about short-term resistance levels or Fibonacci retracements. No, this is about a once-in-a-century market event being masked in plain sight. You see, the system built around suppressing gold and silver prices, through paper derivatives, through unallocated promises, through opaque leasing arrangements, is now visibly fracturing under the weight of its own leverage. And while the mainstream media keeps parroting headlines about healthy inflation expectations, or transitory spikes, or the Fed still in control, what they're not telling you is this: central banks are preparing for something seismic. Let me be crystal clear. This gold run isn't a speculative rally. It's a systemic repricing. What we're witnessing right now is the beginning of a massive deleveraging in the paper metals market, one that will rip through the COMEX, drain the LBMA, and quite possibly mark the final death knell for Western price discovery altogether. And the signs are everywhere. Take delivery volumes. We've now had back-to-back record-setting COMEX physical loadouts. February alone saw almost 6 million ounces of gold delivered, more than 3 times what was normal just 2 years ago. And guess who's taking that metal? It's not hedge funds, it's not ETFs, it's sovereigns, it's central banks, and it's strategic state actors. This is coordinated. This is deliberate. They're not playing a trade here. They're securing wealth. And here's the rub. They're front-running the revaluation. Now we've talked about Basel III before. The fact that physical gold now sits as a Tier 1 asset, risk-free, fully valued at market, non-defaultable, changes everything. Because for 50 years, the West has manipulated gold through unallocated accounts, leasing, and rehypothecation. That era is over. As of July 1st, 2025, every US-based gold position held on balance sheet must be fully allocated and unencumbered. No more fractional claims. No more "trust me, it's in the vault." And that means hundreds of tons of leased gold must either be returned, purchased back at market, or replaced with delivery-eligible metal. And guess what? There's nowhere near enough to go around. This is why we're seeing those EFP spreads blowing out again. At times in March, we saw over $80 premiums on physical gold in Asia versus COMEX spot. Silver spreads reached nearly $1.25. This is historic. That means if you're trying to arbitrage between New York and Shanghai or Dubai, good luck. The premiums wipe out your spread and then some. We even had reports that refiners were refusing to convert 400-ounce LBMA bars into COMEX hundreds because they were backlogged 10 weeks. That's right, not 10 days, 10 weeks. That's a functional breakdown in delivery, and when it breaks, it won't be orderly. You think the Hunt brothers were a big deal in 1980? That was child's play compared to the sovereign bid we're seeing now. Back then, it was 2 Texas oil billionaires and a few leveraged contracts. Today, it's China, it's India, it's Russia, it's Saudi Arabia, it's 45 plus central banks who are dumping treasuries and scooping up metal like there's no tomorrow. Let's talk about China specifically. Officially, the People's Bank of China added over 600 tons in 2024. But let me tell you, that's the tip of the iceberg. We have customs data, import flows through Hong Kong and Shanghai, and it's telling a very different story. A far larger portion of China's gold is being accumulated through offshore vehicles, sovereign wealth funds, and commercial proxies. Our contacts estimate real Chinese acquisition may be over 2,000 tons in 2024 alone. That dwarfs anything happening in the West. And then there's the United States. For the first time since the 1990s, we are now a net importer of gold. Since November, more than 25 million ounces of gold have been imported into U.S. refineries and vaults. Most of it came from London, some of it from Switzerland. It's coming back. It's being reshored. You want to know what that means? That means U.S. actors, quite possibly the Treasury or Fed, are preparing for some kind of reset. Think about that. For decades, the U.S. used to export gold. We were the supplier of last resort. But now we're hoarding. Why? Are we preparing for a new gold-backed digital dollar? Are we positioning to revalue reserves to recapitalize the balance sheet? Possibly, and let me tell you, every $4,000 move in the gold price equals $1 trillion in value added to the U.S. Treasury's gold revaluation account. That's how we reboot this debt-saturated system. Now, the LBMA is starting to look like it's about to default in slow motion. They're claiming 279 million ounces of gold held in London, but only 36 million ounces are unencumbered. That's a 13-to-1 paper-to-physical ratio. And if you think that's bad, wait till you hear about silver. The LBMA's silver float dropped over 128 million ounces in just 90 days. That's almost half the available float. They're blaming logistics, truck shortages, refinery delays. But the reality is this: the metal is gone. It's being loaded out and shipped east, and COMEX is next. There's a reason COMEX just delisted LBMA-linked futures. That's right. The US just quietly delinked from the London gold market. That's like Visa and MasterCard suddenly refusing to clear each other's payments. Why? Because they no longer trust London to deliver. That's the signal. That's the vote of no confidence. And it happened without a press release. They don't want panic, but it's already too late. Let's be honest. These banks have overplayed their hand. The bullion banks, JP Morgan, HSBC, Goldman Sachs, they're now trying to cover. They're racing to secure metal before the music stops. Some are even bidding in the dark pools at $200 above spot for large lots. And still they can't get filled, because nobody who owns real gold is selling anymore. They're waiting for real price discovery. And as price begins to break free, gold isn't just going to 3,300 or 3,500, it's going exponential. Once sovereigns and funds realize they can't source physical at any reasonable spread, they're going to go full panic bid. And silver? Silver is the tightest it's ever been. And unlike gold, silver's above-ground stockpiles are largely gone. Used in solar, AI, EVs, satellites, defense, silver is an industrial metal disguised as money. And once monetary demand collides with industrial supply, you better believe $50 silver is just the beginning. And the mainstream hasn't even noticed. Bloomberg won't touch it. CNBC hasn't covered gold since it was under $2,000. The Financial Times is still quoting sources at the LBMA claiming everything is fine. Meanwhile, the vaults are being bled dry. The spreads are exploding. Sovereigns are racing for cover. And Western investors? Still asleep, but not for long. When the dam breaks, when COMEX or LBMA fails to deliver, it will be uncontainable. That's why we're screaming from the rooftops. Get your physical now, not tomorrow, not next week. Now, because when delivery fails, premiums explode. Availability disappears. The window slams shut. You want to know what happens then? The price is no longer set in London or New York. It's set in Shanghai, in Dubai, in Moscow, in Mumbai, where delivery is real, where contracts are fully backed, where gold is king and silver is sovereign. This is not a prediction. This is already happening. And just to put a bow on it, the very banks who've manipulated these markets for decades are now the ones desperately trying to secure physical. That's your tell. The insiders are exiting, the institutions are allocating, and the people who trusted ETFs and derivatives are going to be left with paper. Let me leave you with this. When gold is revalued, and it will not be because of inflation or debt or war. It will be because the West no longer has the gold. The illusion is shattering, the reset is beginning, and your only escape hatch is physical metal in your possession before it's priced out of reach.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.